Good afternoon and welcome to the Smart Metering Systems PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Tim Mortlock, CEO. Good afternoon to you, sir.
Thank you very much, and good afternoon, everybody. Thank you for attending this afternoon. I will be providing a short presentation, presenting particularly our end-of-year results, but also just an overview of our business model, and we'll be, as was just said, happy to take any questions straight afterwards. So SMS is a business that originates, owns and operates carbon reduction assets that provide long-term, secure, recurring revenues. So we do that by taking our technology platforms, what we call Metis, as an overview, and that technology platform is one that not only allows us to deploy assets, but also to manage them, and also increasingly to optimize the use of those assets. So, for example, assets such as batteries, which are required to be we use those technology platforms to actually operate and manage and optimize those assets accordingly. Alongside those technology platforms, we also take our engineering and energy skills and expertise, and we also then take our capital and funding and align those three things together in order to, as I said, originate, own and operate long-term, secure carbon reduction assets. Now, historically, that equity story has been very much around the smart metering business, and that remains the largest part of our business. But increasingly now we're stepping into other asset classes, in particular grid-scale battery storage, but also other carbon reduction assets such as EV charging infrastructure and other behind-the-meter assets such as solar storage, domestic EV charging and air source heat pumps as well, which we'll touch on in the course of this presentation. Now, for SMS in 2022, we had two key priorities from my perspective. The first was to deliver on and accelerate the delivery of our smart meter contracted order pipeline, and we were very pleased with how operationally that was delivered in 2022. So we installed 480,000 smart meters last year. That was against a self-imposed target of 450,000. In the second half of the year, we increased our meter installation run rates to around 45,000 meters per month, and that compares to it being around 30,000 meters per month in the second half of the prior year. So we were very pleased with that. And what that meant was that then flows through into one of our key financial metrics, what we call index-linked annualized recurring revenues, or ILAR. So that is the recurring revenues that would flow from our deployed metering and meter asset and database if we stop deploying assets today. So at the end of the year, those recurring revenues were £97.1 million, and at the end of February, that had increased again to £98.5 million. And as I said, those will be then adjusted by RPI. They're adjusted by RPI, both the deployed asset base and any future assets by RPI on the 1st of April each year. The second key priority of the business was to bring operational and online our first grid-scale battery plants and to prove the returns from those. And we were very pleased again with how that went. So we brought our first 50 megawatt project online in January of last year, ended the year with 140 megawatts of grid-scale projects live, and also from a financial perspective, delivered around £123,000 per megawatt. So in grid-scale batteries, we're talking per megawatt terms, at the on an annualized EBITDA basis, against a sort of guided range of between £57,000 and £65,000 EBITDA per megawatt. So very significant higher returns than we guided to, and I'll explain a little bit about why that was the case in due course. And of course, all of that just then flows through to the financial performance of our business. So underlying pre-exceptional EBITDA up 21% to 63.8 million. We marginally upgraded those expectations last July and again in January of this year. PBT also marginally ahead, or sorry, materially ahead up 34% to 24.5 million. And again, we'd upgraded those expectations during the course of the year. And we've also now been able to marginally increase our outlook for EBITDA for the coming year, whilst PBT expectations have remained in line with expectations, just given the flow through of higher interest charges, as you probably expect. Now, we ended the year with net debt of 31.2 million, with 355 million of undrawn facilities from our revolving credit facility. So very strong liquidity to continue to deploy our pipelines. And with those pipelines, we still have 2.17 million smart meter order pipeline to deploy over the coming years. There are annual binding installation targets on energy suppliers to deliver the smart meter rollout by the end of 2025 for 85% of all meters in the country to be exchanged to smart. So we have a very strong pipeline in smart meters, and also a growing and strong pipeline of grid scale batteries. So you can see there 860 megawatt total pipeline, of which, as I said, 140 megawatts live at the year end. So just to touch on those index-linked annualized recurring revenues that I referred to from our metering and data assets a little more, you can see there on that slide that since we listed back in 2010, 2011, we've had 29% compounded annual growth rate in those index-linked recurring revenues. That's after the effect of an asset disposal that we did in 2020. And on that occasion, we disposed of a minority of our industrial and commercial meters for 16.4 multiple of ILAR for assets that were just under 5 years in age. So I think that provides a very strong read across in terms of the value of our asset base. The current smart metering portfolio average age is just under 3 years. And as I said before, that we entered the year with 97.1 million of ILAR in our metering and data asset base. And that pipeline that I just referred to of 2.17 million smart meters on deployment will add another circa 50 million or 48 million there to our ILAR over the coming years, excluding the impact of RPI, which will be added, as I said, each 1st of April. And this year will be circa 11%. Now, in the smart meter rollout and in that asset base, we contract with the licensed energy suppliers. So if an end consumer or meter point moves from one energy supplier to another, then we simply stop billing the first supplier and start billing the next on a daily basis. Within the asset management division that these assets sit in our business, we have a circa 92% gross cash margin, and that's growing as well. And that's because smart meters have no maintenance cost, if you like. The only cost of sale is depreciation, and therefore a very cash generative asset. We also have in perpetuity contracts. So our contracts with energy suppliers last for as long as we are billing meters to them. So they don't have an end date, if you like. And where we are what's called the appointed industry meter operator or meter asset manager, we also have the right to replace those assets at the end of life as well. So this slide just provides an overview of that deployed meter asset and database. Just a couple of things I would point to here. So firstly, we now got just over 2.1 million smart meters deployed, delivering 61.1 million of recurring revenue. As I said, 2.17 million order books still to be delivered, and that will add another circa 50 million to those. And the second thing I would just quickly point out is that you will see there 11.2 million of recurring revenue associated with traditional meters. And those are meters that you would expect to be replaced and come off the wall during the course of the smart meter rollout over the next few years. So that would fall away. And as I said, we're very pleased with how the operational delivery of this part of our business has delivered over the last year. You can see there in the top left how those run rates of meter installations have grown over the last couple of years. As I said, we delivered 480,000 meters last year, and we're targeting delivering 600,000 meters in the current year. And we expect that to carry on over the next couple of years as well. We've now been installing around 14% of all UK smart meters last year, which again is something we're very pleased with. And in addition to the existing pipeline that I just referred to, we still continue to see opportunities in the market to grow that pipeline further. We believe between 2 and 3 million meters. And some of that opportunity is with customers with whom we have minimum contracted volume commitments. But that's within contracts where we have essentially framework, as I said, in perpetuity agreements. But there's no inherent reason why, when we hit our minimum contracted volume commitment, we would just stop. Clearly, that could happen, but equally, I probably expect us in many cases to carry on to work with those suppliers beyond that initial contracted volume commitment as well. Now, finally, just on smart meters, some of you may have been aware that early in the rollout, there was what was known as SMETS1 meters, which were meters that communicated via the meter manufacturer's software, and that therefore on churn of a meter point from one supplier to another, there was some, I guess, noise around the industry where some of those meters would not communicate once they moved to another supplier if that supplier didn't operate that type of meter manufacturer's software. Well, that issue is gradually being resolved over recent years, as all of those SMETS1 meters are going through a process that's called enrolment and adoption, where their communications are redirected to the central data communications company set up by the government to collect data from all smart meters. And I'm pleased to say that 80% of our SMETS1 portfolio has now gone through that process, and those meters effectively now operate like a SMETS2 meter as well, which again we're very pleased with. Now, one of the features of our business over the last 2 to 3 years has been us stepping into grid-scale battery storage, as I mentioned earlier. Now, just to be clear, this is building on over 20 years' experience of designing and delivering large-scale electricity infrastructure. This is a very different engineering challenge to meters, if you like. In metering, we have around 600 engineers in vans around the country installing meters on a daily basis. These are very different types of sites. They are, in effect, an extension to the local DNO electricity network, and large parts of the sites are made up of substations, transformers, switchgear, and so on. 40-year plus life assets, just the same as a local distribution electricity network. And then alongside that electricity network, we site lithium-ion battery cells, which we can store electricity in and discharge that electricity to support the grid when needed. And those lithium-ion battery cells, we have throughput warranties over, which, if you cycle those batteries on average 2 times a day, will last for 10 years. So there's a replacement cycle of around 10 years on the lithium-ion battery cells. Now, as I said before, we now have an 860 megawatt pipeline of grid-scale battery projects, 140 megawatts live, and we've been guiding to an EBITDA expectation of between 57 and 65,000 pounds EBITDA per megawatt going forward, driven by balancing services to the grid. And this slide just sets out not only, therefore, the expected contribution from this part of the business based on that guidance from the operational sites, but also from the pipeline, so the 860 megawatts there, on deployment, that will, as I said, provide EBITDA of between 49 and 56 million pounds. But we've also set ourselves a target of delivering at least 1.5 gigawatts of battery storage by 2030, which would, as you can see there, generate close to 100 million pound of EBITDA as well. Now, grid-scale battery storage is fundamentally required and is driven, and that need is driven by the increasing amount of intermittent renewable generation coming onto the grid. And that increasing amount of intermittent renewable generation drives volatility, not just volatility in terms of power prices, but imbalance between generation and demand at any individual point in time. And batteries are very well placed to service that requirement because they operate, if you like, in minutes and hours. So they're very short-term and fast response to address that imbalance on the network. And that imbalance drives spreads between the cost to charge a battery and the value to discharge a battery. And this is the primary source of revenues for batteries for providing balancing services to the grid, just as assets like pumped hydro stations have provided those services for decades. Now, whilst we expect those storage spreads to grow over time, we've taken a conservative view over the expected revenues over the near term out to 2030, and that's what our guidance is based on. But this is in the context that National Grid have forecast a requirement for the existing circa 4.5 gigawatts of energy storage on the grid to increase to over 18 gigawatts by 2030 and around 38 gigawatts by 2050. Now, of that energy storage, around 2 gigawatts currently comes from lithium-ion battery storage, but again, that is expected to grow and is forecast by National Grid to be required to grow to over 14 gigawatts by 2030. And as you can see there, around 26 gigawatts by 2050. So there's a very strong and increasing need for this asset class, fundamentally to support the grid to accept intermittent renewable generations onto the grid over the coming years. Now, as I said, our pipeline of 860 megawatts projects, you can see there we've got on the right hand side 140 megawatts operational. There's a further 150 megawatts from our secured sites that is in construction and will be delivered during the course of this year. And we've guided clearly for those operational sites, but also for the sites in construction, to a capex cost of around £380,000 per megawatt. Now, for the following sites, we do expect that to increase slightly to between £400,000 and £450,000 per megawatt, driven by increasing commodity prices. But we're very pleased with the way that overall pipeline is developed. And I think I would expect to see us continue to grow that overall pipeline and continue to bring sites through from the left-hand side of that slide to the right-hand side as we fully secure sites and take them into construction and ultimately to being operational. Now, as I mentioned, grid-scale batteries fundamentally provide two types of services to the national grid. The first are balancing services, and the second are frequency services. Now, balancing services are those services, as I was just briefly describing, and represented there by the dark green on the left-hand side, where we, in effect, charge the batteries, if you like, during the night when power is cheap, and discharge the batteries, if you like, when power is expensive during the evening when there is high demand on the network. Now, in reality, it is much more iterative, and it could be on a half-hour basis throughout every single day that we're responding to that imbalance on the network. But it is on those balancing services that all of our EBITDA guidance is based. And those spreads and the requirement for those balancing services are quite predictable and well known, albeit are growing in time, given the increasing amount of intermittent renewable generation coming online. Now, within those balancing services, one of those types of services in there you'll see is the capacity market. And we've been successful in putting 360 megawatts to date into the capacity market auctions run by National Grid, which is where there are effectively standby availability charges paid by National Grid in 15-year CPI-linked contracts, effectively for batteries in this case to be on standby to the grid if required. And that those 15-year contracts provide around 20% of the revenue guidance that you see there, with the balance all provided from in day ahead balancing services to the grid. Now, what we've also always said is that where it is value accretive to do so, instead of providing those balancing services, we would provide frequency services to the grid. Now, frequency services are represented there by the light green on the left-hand side, but this is where we are able to support the grid to maintain frequency levels within plus minus 1% of the statutory requirement of 50 hertz. And batteries, again, are very well placed to provide those services. And this is exactly what we saw last year. For over 75% of the time, our batteries were providing frequency services rather than balancing services. And that is what drove the much higher than expected returns, so around £123,000 per megawatt on an annualized basis versus that guidance of 57 to 65. So, do we expect those frequency services to continue at that level? Well, bluntly, no. As more batteries are brought online, we expect that part of the market to become more saturated and the revenues to fall away accordingly. But as I said, all of our guidance is based around the long-term provision of those balancing services accordingly. Now, I think over the last week in particular, by a few people have been accused of being quite conservative and prudent, therefore, in terms of our guidance. And I've also been asked, well, is that going to be a cliff edge, in terms of the drop of those revenues? And the answer is, I don't know really, but I think my best guess would be a more gradual transition to that guidance. But as I said, these are 40-year plus life assets, and we're very confident in our guidance, and we want to make sure that we're providing guidance that stands the test of time as well. Now, beyond grid-scale batteries and meters, we also have a number of what we would call developing assets, carbon reduction or care assets, as we talk about them. And perhaps I'll just pick out a couple of points here. So firstly, within data services, we already have over 16 million of recurring revenues that come from our data services to the grid, underpinned by our Metis technology platform. We made one strategic investment in the last year in this space to acquire the N3 business that you can see there, and that was to enable us to directly access half-hourly consumption data from smart meters, from that central data communications company that's been set up by the government, and that's going to enable us to offer half-hourly settlement services to energy suppliers as the entire industry moves towards mandatory half-hourly settlement by the end of 2026, and we see that as a very significant opportunity for the business to grow our data services over the coming years. We also made a second strategic investment last year in Clenergy EV. Clenergy EV operates around 2,700 public EV charge points across the country, and bringing that technology platform in, which is what's called a CPO or charge point operator platform, that allows us to control the use of public EV charge points and the collection of revenue from them, and aligning that technology platform to our existing electrical installation and capabilities means we can now offer a turnkey solution to originate, own and operate public EV charging infrastructure, which we are in what I would describe as pipeline build mode for at the moment. We're also developing our behind the meter solutions. Now, our behind the meter, so in commercial and domestic properties around the country, delivering solar storage, domestic type EV charging and solutions such as air source heat pumps. We see this as very closely aligned to the existing engineering capabilities of our engineers. Those 600 engineers who are delivering meters in particular at the moment. We can reskill and upskill those engineers to deliver these assets in our own training academies. And those assets provide a very significant opportunity and are integral to the delivery of net zero across the country. And when you look at the capital requirement for that type of asset class, just solar and storage alone can typically be between £7,000 and £9,000 per property. And we're seeking to work with social landlords and housing associations, in particular in the first instance, to develop those solutions. And we see, as I said, a very significant and long-term market requirement for those asset classes, underpinned by our engineering capabilities. And finally, we already provide energy efficiency services to commercial companies in particular. And again, particularly given the increase in energy prices, we see that as a growth area of our business going forward. So from an ESG perspective, clearly sustainability is critical across our business. I won't spend too long on this slide. I hope most of this talks for itself, perhaps other than to say, even more so than ever before over the last 12, 18 months, we've really focused on the S in ESG, if you like. So looking after our people, that's something we're very focused on doing, and driving fairness and equality in the way that we treat all of our staff and recruit all of our staff as well. And we're very proud of the business performance in this area. And again, that's underpinned by the governance in business, where we continue to have the highest rating from MSCI for corporate governance, which we're, again, very pleased with. And all of that underpinned by, we have our own net zero target for our own operations to deliver net zero by 2030, which we're well on track for. So just in summary, yeah, as I said, we have a very strong platform with inflation-linked contracts that provide, in our metering and data business, provide strong protection against the inflationary environment. As I said, we'll be applying the RPI adjustment to our revenues in that space in the 1st of April this year, just as we do every year. And we have a very strong pipeline of meters and grid-scale battery storage to be delivered, which will more than double our EBITDA over the next few years. So delivery of those pipelines alone will more than double our EBITDA. And as I said, we're also making significant progress in growing those pipelines, but also in seeking to develop and expand other care products and services alongside it. We've got a very strong liquidity position to support the delivery of those pipelines, with us just starting to step into our revolving credit facility towards the end of last year, and also a very strong long-term dividend policy. We've committed to, over the last few years, to growing our dividend 10% year on year, and that commitment remains in place through to 2024. And as I said, from a results perspective, last year, EBITDA marginally ahead, PBT materially ahead. We were very pleased with those results and the operational performance of the business. And that's just continued to drive through into the 2023 outlook as well. So look, that concludes the presentation. There is a copy of our end of year results presentation that's available online as well, but happy to take any questions that you may have.
Tim, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Received a number of questions from investors, and I want to start off the Q&A session with this one here, which reads as follows. Where do you see the business in 5 years from now? How much of this growth has been locked in through the existing pipeline?
Yeah, I guess, as I just said, really, the existing pipelines alone will more than double the EBITDA of the business. So, I guess I see that sort of growth as fairly locked in our business, really. So for me, where do I see the business in 5 years' time? I see it as going significantly beyond that, frankly, because within those asset classes, I see much greater opportunity. Particularly when you look at the scale of the requirement there for grid-scale batteries that we touched on, but also in those other asset classes. So in 5 years' time, I'd like to see our engineering activity not just deploying meters, and meters will always remain a large part of our business. But I'd really like to see us delivering those other care assets that I touched on there at scale. So behind the meter assets in particular, things like solar storage and air source heat pumps and EV charging infrastructure, and I think that provides a lot of runway ahead for growth, both within our existing established asset classes and beyond.
Perfect, thank you very much. The next question here reads as follows. In one of your slides, you show 92% gross cash margin. Given your assets the long term, where does this cash margin go in the medium term?
So as we get towards the end of the smart meter rollout, in particular, we'll have decisions to make in terms of how do we structure that part of the business, which, as you said, is highly cash generative. Now, whilst we've got the growth in our business that we see now and that we continue to expect over the long term, clearly we've got the opportunity to continue to deploy those cash returns into further assets to deliver growth for the business. I think that clearly will be a large direction for the business. But clearly we also need to consider things like our dividend policy and how do we and if and how we should return cash from those very cash generative assets to investors over the medium term as well. As I said, dividend policy, we've sort of committed to that through to next year, and that's part of the mix of our capital structure, really, that we need to think about carefully over the next couple of years.
That's great. How much capital do you need to fund your pipeline growth, and what would be your preferred funding mechanism?
Yeah, so I guess the way I'd characterize that, the simple answer is there's around 700 million, just over 700 million required to deliver the existing pipelines. As I said, we have a 420 million RCF, plus we are clearly a cash generative business to support that. I guess the way I would describe it is that when we did an equity raise in September 2021, and when we did that, we always said at the time that we would be on deployment of the pipelines that we had at that point in time, that we would be circa 3 times levered, debt to EBITDA. And we always sort of said that circa 3 times levered is sort of as far as a public listed business, we feel comfortable pushing our debt. So what's happened since then? Well, the pipelines have grown, particularly in grid-scale batteries. So what does that mean? Well, now if we were to fully deploy those pipelines I've been talking about, well, we would be over 4 times levered. And therefore, that would be a bit higher than, as I said, we feel comfortable as a public listed business. Now, to be clear, the assets could take a much higher leverage. That's absolutely the case. I know the banks would support us in that, and the covenants wouldn't be stressed within that at all. But just where we feel comfortable as a public listed business, I think they'll be pushing it too far. Now, to be clear, if all we were ever going to do was deploy the existing pipelines, I think you'd probably still maybe use debt, because at the end of that deployment, then you would see that debt fall away quite quickly as the cash sort of flowed in from those assets. But clearly, as I've described, I don't think we see the growth of business like that. We see continued opportunity to grow the business beyond those pipelines, and therefore it's incumbent on us to take appropriate action at appropriate time to address that leverage, particularly as we get closer to that 3 times self-imposed level. And we've got about 18 months runway before we expect to get to that point. Now, so what are the options to deal with that? Well, clearly you've got debt, and I've just sort of touched on that, and you've got other options around debt, things like longer duration debt and how we structure particularly that metering business. But ultimately, I think debt is probably debt from a public market perspective. We could go back to equity. We did that last time. I don't think right now that would perhaps be our preferred option, but clearly we keep it on the table. As I said earlier, back in 2020, we did an asset recycling event with meters. Now, going forward over the next 12, 18 months, clearly we've got a much larger portfolio of smart meters now. We've also got a large and growing portfolio of operational grid-scale batteries. So we've got some optionality if we chose to go down an asset recycling path in terms of what we would do. And that would probably be the preferred type of option as we sit right now. But we've got decisions to make over the next sort of 12 to 18 months at the appropriate time.
Perfect. Thanks for that, Tim. A question here around your dividend policy, which I know you have talked to during the questions, but the question asks, what's your thinking beyond the period of 2024?
Yeah, well, we've always been a dividend-paying stock since we listed, and that's been an important part, a feature of the business. We reset the dividend policy back in 2020 post that asset recycling. And again, that's been an important part of the story of the business since then. Look, so I guess what I'm saying, I don't see it's not being a dividend-paying business, and I can't see it going backwards, if you like. So the question really is, well, where do we take it from there? I think the default position would probably be for it to be linked to inflation along those sort of lines, but we'll see. Obviously, that's part of the mix of the funding strategy of the business over the coming years, and we'll take it from there. But I'd expect us to sort of confirm that view certainly by the end of this year.
Perfect, that's great. EV charging looks to be a driver for growth. Are there any plans for further strategic investments to be made here, and if so, to what quantum?
Yeah, so you saw that we made that small but strategic investment in terms of bringing some of the technology platform that we felt we wanted to have some level of control of into the business over the last year. I wouldn't rule out any further M&A in this space, but equally, I think we've asked ourselves the questions, to be frank, do we want to use M&A to drive the pipeline growth and accelerate the pipeline growth in this space? I'm not sure we've really seen what I would describe as value from that perspective in terms of the opportunities to do that. So right now we're just focused on growing our own pipeline of activity. I see 2023 as very much a pipeline growth phase of that business rather than, if you like, a capital deployment sort of phase in earnest. It's a bit like where we were on grid-scale batteries 2.5 years ago, frankly. And we, as you may know, we have relationships with lots of business energy customers already, so people like hotel chains and pub chains and people like that. So I'd probably expect to see us try and seek to leverage those type of relationships in terms of where we could take that pipeline as well.
Perfect. We've got another question here which asks, are there any plans to move to the main market from AIM, and will this broaden interest from institutional investors?
Yeah, this is something we sort of regularly consider as a board. I think the AIM market's been good to us. We're a high growth business, and therefore there aren't any sort of imminent plans to move away from AIM. It's something we keep under review, and I think whilst we are a high growth business, I think we feel comfortable that AIM is the right place for us, and gives us a bit of extra flexibility that it gives us there. But yeah, we're not blind to it, I guess, to the question as to whether moving to main would provide some other opportunities for the business. But right now and for the foreseeable, we're comfortable with the position we're in.
Perfect. And maybe just one final question here, which reads as follows. You mentioned potential move into heat pumps. Is this for residential or industrial? And how big do you think the heat pump market will be in 5 years' time?
Yeah, well, our energy business already helps a number of business energy customers to move towards more efficient and sustainable heating systems, such as heat pumps. So we're already active in that market. I think where I particularly see the opportunity here is that in the residential space, as I said, in that behind the meter space of solar storage, air source heat pumps definitely as well, domestic EV charging, we can extend and reskill our engineers in order to deliver that asset class. And we've seen the government put out targets for 800,000 heat pumps a year to be installed by 2028, which frankly I I don't think the industry as a whole has any chance of hitting, but that is sort of a sign of some of the ambition of where things are going. And therefore, I'd like to think that in 5 years' time, that could be a very material feature of the business. Again, the sort of capex for that type of solution, whilst I expect them to come down, is typically sort of £12,000 to £15,000 for heat pumps. So as I said, I expect that to come down a little, but still, the capital requirement for these assets is very significant. We have the engineering skills to deliver this important asset class for the energy transition, and I think therefore I see it as being a very significant feature of the business, certainly in 5 years' time.
Tim, thank you very much for that. I think you've actually managed to address all those questions from investors, and of course the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to yourself and the company, Tim, could I just ask you for a few closing comments?
Yeah, sure. I guess my closing comment really would be that we as a business have put an awful lot of effort in over the last few years to make sure that we are doing what we said we were going to do, plus a little bit more. And I would like to assure all the investors on this call that that's exactly what we're continuing to seek to do. So we're just very focused on doing what we said we were going to do, and plus a bit more, hopefully. And we see huge opportunities for the business ahead. But therefore, what we're focused on is continuing to deliver on those pipelines and deliver the returns from them and the growth that will flow from them. And I'd just like to thank everyone for your time this afternoon.
Tim, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Smart Metering Systems PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.